Okay, hello everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. We are just getting the release of the third and final read on first quarter GDP, coming in slightly stronger than expected on the quarter-on-quarter. Personal consumption coming in weaker than expected. Again, the health of the consumer not exactly where the Fed wants to see it. GDP price index at 0.4 misses consensus. Core PCE, the Fed's preferred gauge of inflation, also slightly missing expectations. So not necessarily going to be a broad dollar rally here on this, guys, but the takeaway, obviously, a slightly better than expected quarterly annualized GDP for the first quarter, and the slightly weaker than expected core PCE are the takeaway that you want from here. Shouldn't see too much volatility. We have a lot of headlines coming out of Europe that should really guide broader risk appetite. But certainly gets this out of the way. For the remainder of the session, you still do have the S&P Case-Shiller Home Index, which comes out at 9 o'clock. And more importantly, the Richmond Fed Manufacturing Index that comes out at 10. So keep that in mind. You're looking at the picture of the dollar index here. We're not seeing any much initial reaction. Like I said, there's a lot of headlines coming out of Europe right now, which should really be the driver. But certainly continues to put the Fed the bar, sets a high bar for the Fed to really be able to do anything. Guys, if we take a quick look at the Fed Fund futures, a dramatic drop-off, right? A dramatic drop-off. In fact, if we go to the last update here, I'm not sure if it was in the 22nd, might have been previously, but we did see, obviously, a huge shift in the probability of the Fed's expected rate move. Here's what it looked like back on the 14th, okay? And you can see the massive shift, right? Markets were expecting a 51% chance for a February hike. This is ahead of the Brexit. Here's post-Brexit, 13.7%, which indicates that, in fact, this doesn't go back past February, but when we look deeper, there's really no expectations till the second or third quarter now for the Fed to be moving higher on rates. And even more interesting is the probability of a cut. So you can see that for basically September and November, we're looking for probabilities of above 13%. Obviously, a stark contrast from what we've been seeing. So the market's expectations for a Fed hike have all but shifted at this point, which suggests, or which begs the question, why is the dollar rallying, right? And the simple question is, guys, it's risk aversion. There's times, again, where the dollar will catch a bid based on expectations for the interest rate differential between these countries. And there's times where the dollar will catch a bid based on investors seeking the relative safety, looking for a store of wealth outside of broader risk assets. So I think that's what we're seeing here in the dollar. Again, continuing really on the rally here. The interesting area that we highlighted in last night's piece, at least on the radar chart, was right here, was this region. A nice trendline resistance. This is a sliding parallel for the current operative slope. If you guys remember, we were talking about this slope saying, you know what, we really don't have too much conviction to really stress this slope just yet because we haven't seen any pivots, inflections, or reversals off any of these median lines. Here's the first one, and I think this warrants some attention here. So basic support, basic resistance, same slope as the operative one we've been looking at. So we'll continue to keep that in mind. It keeps the focus higher while above 11,938. Not only is that swing high that we made, but you also have the 100-day moving average to contend with and the median line parallel. So major key support for the dollar, just higher. You have the key 618 retracement, obviously 12,064, which coincides dead on with that sliding parallel. So could see some further upside before we turn over, but the broader rally is vulnerable heading into this 12,064 level. Again, key support 11,938. Hey, Amir, great to see you. Eileen, always a pleasure. How did folks find your webinar yesterday? When I clicked on your links, they all went to FXCM. Other webinar/chat box software. Yeah, Eileen, so we're on Daily FX. I'm just moving them over into GoToWebinar. There was a little confusion yesterday. I apologize about that. But I actually did tweet it out. So I think that's how most people found it. Moving forward, I do think FXCM will be utilizing the GoToWebinar. It's just a much more robust package, in my opinion. Again, anyone here who's new to the room, there's a camera button in the top right-hand corner. Clients love that. Really allows you to take a snapshot of any of the charts, any of the analysis that you see presented in these webinars. So um, Eileen says, tweets, better get more on board. Okay, then. Cheers, Eileen. Amir, no worries, man. Good morning to you. Arthur, Horace, Hussein, James, Lynn, Mark, Medad, Pete, Pooja, Saful, great to see all of you here today. Hope everyone is surviving these days, says Amir. Yeah, so look, added caution is definitely warranted in this environment. I'm not going to lie to you guys. I've been very, very nimble. I took a long yesterday on the Aussie dollar from a scalp off the lows. Worked out pretty well. Other than that, I'm pretty much sitting on my hands. And that's not a bad thing, Amir. You know, one of the most important thing I want to say for retail traders is knowing when to press those trades, knowing really when to get heavy, and knowing when to sit out. Flat is a position. So, Amir, I don't want you to get too concerned. The market will always provide more opportunities. We just got to be here to find them. So, if you find yourself a little bit more timid these days, if you find yourself a little bit more gun shy or trigger shy, that's completely okay. I'm there right with you. So Amir says, agreed. Medad says, great to see you too, mate. Hey, cheers, Medad. Great. Always a pleasure, my man. So we got the data out of the way. I wanted to show you the interest rate probabilities here, which have shifted dramatically. And again, here's what the relative performance so far looks like on the dollar heading into the open. Give me a second. So you can see that the dollar is actually, this is the pound. Okay. It's actually weaker than all of its major counterparts, save the yen, which is what I want to point out here. You can see the pound with a nice rebound. We'll go over that trade. It turned right ahead of a major inflection or confluence of median lines, which we'll review in a moment. Kiwi up 1.11%. We highlighted that also on last night's radar charts, coming off a big support region. Huge. This same 30 pip region, guys, has been so critical for analysis on the Kiwi over the last couple of months. You can see, obviously, through the break that we made earlier the month on the pullback, we found support right there. Obviously, the breakthrough key resistance quickly posted an outside day key reversal on Brexit. And again, that drop now finding some support once again, 69.70 into the 70 handle. You're seeing some rebound here. I do like the broader short side for Kiwi, but this is critical support. Okay, so we are looking for entries on the way up. I think Jamie has an order for you guys somewhere around 70.50. I do like the move for sure. I do just want to highlight that this is the key support that we need to get through. And let me show you a little bit more clearer on the daily chart what exactly is there. Okay, so you have a basic 50% retracement from the decline. No big deal. We already made a couple passes through that. You also have the 100% extension from the ascent off the lows. And that was a nice pivot zone that we've been working with. You also have basic trendline resistance dating back to the highs that you made back here in October of 2014. Okay? Breakthrough, support. You also have a basic trendline support, which has acted as a really nice pivot, which also coincides on there. So four-way confluence really gives respect to this 30 pip range. That's what we need to clear to the downside to get a little bit more play on the short side of Kiwi dollar. So another one that we'll be tracking very closely. I'm on the hunt here for some, like I said, some short entries. Remember, to fill the gap, we would necessitate a rally up to 71.18. That'd be the first area I'd start to look for some possible short exposure here on Kiwi. There's really not much to look at in the 30-minute chart here, guys. It's just the same levels. So I don't really want to stress this, but certainly near term, we'll be looking for that rally to fizzle out right near the open, or right near the close, rather, of Friday, if we can get a stretch that high. Amir, I got you, my man. Sterling coming right up. Sterling dollar, sterling yen on the list. Promise. All right, any questions on Kiwi? So a nice little pop off this region. Again, initial target 70.53, next one 71.18. And again, we'd like to look for some short entries in that region. As far as the Kiwi docket's concerned, I'm pretty sure you're spent. I get building permits on tap tomorrow. It shouldn't be a major market mover, but you're really, you'll be wanting to focus on U.S. data. Later in the week, we get personal income, personal spending tomorrow. Pending home sales should be a decent play, but nothing major. More importantly, ISM manufacturing orders, those come in right into the close of the week. We're looking for a print of 51.3. This is for the month of June. All right, let's move on. Let's just finish up the radar charts while we're here. So I also have a setup in dollar CAD over on the intraday update from last night, but I also wanted to highlight the crude trade because a lot of people are going to be looking at both of these. So here's what crude looks like on the near term. All right. So yesterday we highlighted that crude was coming into the bottom or into range support. I called it right at 45.98. 45.98 was actually the May open, but more importantly, it's been a decent pivot in price. And you can see, obviously, the open, the break, checked it as support, checked it as support. Once again, rebounding off this region. Interestingly enough, a 100% extension from the decline off the highs takes you to 44.68, which coincides very nicely with the median line or the 50 level of this current operative formation. You see that? So we came in, we tagged median line resistance, came off, you look for a tag of that 50 line, and that coincides with the 100% extension. So even if this is just corrective, 2 equal legs down should take you into this region. That said, like we said yesterday, we're heading into range support. So shouldn't be too surprised here to see a little bit of a rebound. Near-term resistance being checked right now at 47.73. We highlighted that yesterday. And the bearish invalidation level is still all the way up at 51. I recognize that that's a ways way off from where we are now, but this is the only region really that would shift the broader focus right back up to the upside. As I noted yesterday, RSI is turning increasingly bearish. This is the deepest probe sub 50 that we've gotten essentially since February, on the way up. Exact resistance at RSI at 60. That's exactly what you want to see. And then another break below 50. So long story short, could see a little bit more recovery here. You'd be looking for short triggers while below basic trendline resistance for a move into 44.68. And interestingly enough, that kind of coincides pretty well with what we're looking at in dollar CAD. We'll take a jump into that in just a moment. Any questions here on crude before we move off? So again, nice highlighted bounce off support there, inevitably looking to use that rebound to get back towards 44.68. And by the way, if this breaks, there's really nothing until 43. It's just a soft target, the May low. More importantly, this huge region of confluence support. A 1618 extension from the decline, a 38.2 retracement of the ascent, the March high, and the 100-day moving average all converge in this region. So I think the levels are absolutely spectacular here for crude. They've been good for a really long while now, I should say. Look for this rally to fizzle out, offer some nice possibility for short exposure. Questions on crude? All right, so those were last night's radar charts. Let's go ahead and jump into covered crude, Kiwi, and dollar. We ran through these today. Awesome. Okay, now let's jump into last night's update. Here's what that looked like. And they're really based all in the dollar crosses. And again, some interesting price action on the Swissy. We haven't really highlighted the Swissy too much in the intraday webinars. Hasn't really been, one of my favorite plays over the last couple of weeks. You saw a lot of consolidation, a lot of back and forth. In my opinion, it was a chop fest as you made this run into the sliding parallel here. But obviously the Brexit play prompted something big. The area of resistance that we're probing now, also an area of interest. Look, I do like this trade higher. I think near term, though, you need to be a little bit more mindful of this resistance range. You're looking at a basic 618 retracement of the decline. Interestingly enough, I actually noted this yesterday, guys. All of these circles they see here were put together during our webinar. I actually haven't highlighted this on any of the reports over the last couple of weeks. And they played out pretty good. We came right into the low day close from May. We probed right below it pre Brexit. On that probe, um, you can see that momentum held 40 on the downside. And then obviously the rally here, you're seeing a 618 offer some resistance. You also have a basic trendline support off the lows that you made in May of last year. Okay, coming right into play. Nice pivot, just above, catching the stretch highs here today. So, right into resistance, right? As we were highlighting yesterday. Here's what it looks like. Here's what it looked like yesterday in the 30-minute. Here's what it looks like now. So we're still stuck. We're still stuck in this godforsaken range here, just below, straddling that 618 retracement. Interestingly enough, again, a sliding parallel of that slope. Again, we said, as we noted, this was way early to really rely too heavily on this slope, although you got a nice reaction off the median line there on Friday, which was the Friday low. A sliding parallel of that same slope almost caught the highs here to the pip. So again, you're looking at buy pullbacks. Initial support comes in right at the open for the week, which also coincides dead on with the 100-day moving average here. And we'll look for a constructive bias while above that 97 region, basically the median line here off the lows. Inevitably and ultimately, you're looking for a stretch into the upper median line parallel for this formation. Okay, that's really the major test of resistance that we'd be looking for. So a stretch higher, 200-day moving average comes in at 98.40. The actual median line right now comes in somewhere around 98.90, 98.88. So looking for a pullback to get long here. I'm not interested in chasing the long side at all from this level. And what the dollar index is doing, although Swissy is not represented in that, right? Coming off some resistance, maybe you can get some downside play in the Swissy to offer a better opportunity to get long on this pair. Any questions on dollar Swiss? I know it's not the prettiest chart, guys, but the levels are pretty clear, specifically on the daily chart. I think that's where most of the clarity comes on this. With this key region of resistance, look for the kickback, and again, see if we can't get that stretch into the upper median line parallel. I heard Swiss Bank intervened with Swissy during the Brexit, says Eileen. Yeah, I heard something to that degree as well. Could be the case, might not be the case. I don't know, Eileen. You're going to get a lot of that, and I don't think the intervention game is done. I think you're going to get much more intervention as we move forward. The biggest threat of intervention really comes from Japan. If you look at the yen crosses, guys, the BOJ is not happy. If anything, the Brexit has really put a burden on them to really have to. Let me take a step back. They're going to have to come back and do something, because this yen strength, based on outflows, based on risk-averse flows, is really going to be detrimental to their economy. They're an export-driven economy. It makes exports much harder, much less appealing. And certainly with the BOJ already at negative rates, there's really not much they can do outside of intervention and buying up corporate assets. So we'll see. But yeah, those intervention comments and headlines, Eileen, I'm expecting to see much more, which is why me and Jamie continually, stress to you guys, be nimble, especially on sterling pairs, especially on euro pairs, especially on Swissy pairs right now, the yen obviously, and be very cognizant that at any moment you might see some central banker come out or some headline cross that intervention's underway, and the market will move 100, 200 pip move. So those types of things, Eileen, you can't trade it, right? You just have to be aware of them. You have to keep your eyes peeled. We're going to continue to be guided by the technicals as always. Is it a 200-day moving average on the 30-minute chart? No, this is the 100-day mirror. And you can do that, my man, by just double-clicking on it and going to the data source and selecting the period. So I can still show a 200-day moving average on my 30-minute chart instead of a 200, 200 moving average on just the 30-minute chart. I want the 200-day moving average. So you can always change the data source to make sure you're locked on the daily range. Does that make sense? Mir says, okay. Eileen says, okay, eyes peeled. Right on. And we'll keep you updated as much as we can on this side, obviously, Eileen, with those comments. But there's no way we can trade those. We just got to be aware of the conditions that we're trading within. And they do warrant a little bit more of a cautious approach. Cautious on the Swiss pairs, like yen? Yes. So we'll go over those. But the Swiss pairs will be a little bit of a different play as opposed to euro. I still think dollar Swiss, the levels are pretty clear. So we'll be looking to see if we can't get some sort of pullback here to get back on the long. Any questions at the on dollar Swiss? Check in resistance right now. Keep your eyes peeled on that trend line off the lows from last year. All right. Right along from yesterday, we also covered the dollar CAD. And in line with what we were talking about with crude, here's what dollar CAD looks like on the daily chart. And then we'll jump into the 30-minute. So I recognize it's getting a little messy here, but, and that's a capital but, we're coming in some interesting resistance levels near term. I do like this thing higher, generally speaking. I think you're going to get a little bit more chop. Today we did officially fill the gap from the Sunday open after coming off this 100-day moving average, which has actually offered a pretty decent pivot in price over the last year or so. You can see some support, break below, resistance, break above, support, break, run, resistance, right? Comes just above basic trendline or channel resistance extending off the May highs. So in combination with that reversal that you're seeing in price here, you also have momentum coming right off of 60, okay? So not the best indication that you're going to see this thing continue higher, which is why near term, I do think you're at risk for a little bit of more of a pullback here. Here's what the 30-minute chart looks like. Haven't really changed any of these levels for the last couple of days. They've remained broadly the same. The pullback, like I said, did materialize. You filled that gap, but here you are right back above the weekly open. So for me, this thing has simply set the weekly opening range right below resistance. And resistance is at 131.20. 131.20 being the high day reversal close from May, specifically the May 24th close. That was almost the exact high that we made yesterday. We just missed it by a pip. Okay, so you have a very convincing, very well-defined weekly opening range. We'll look for a break of that. Again, put a gun to my head, I would say that this thing would break lower, and you look to play, or you look for that drop to give you a little bit more of an entry lower down. The near-term bullish invalidation level, or the constructive level I would like to keep, is 28.95, basically Friday's low. You can see a nice little drop there that we made back in May as well, right around that range. And as long as we stay above that parallel, that basic Friday low, I would like to see the sterling give us, or dollar CAD, give us a move higher. Topside resistance targets, if we do get through, 31.66, 32.18, and then obviously the 38.2 retracement comes in at 133.11. 33.18, by the way, this is what I wanted to remind you as well. 33.11 is that 38.2. It's this retracement. I don't have it here just to keep the chart from getting too cluttered, because at 33.18, just 5 pips higher or so, you have that 200-day moving average. Questions on dollar CAD at this point? Okay, let's jump into the Aussie, which was the final setup from yesterday and my favorite setup. I think this one gave us the best plays. If you guys remember this from earlier in the week, here's what the radar chart looked like on Sunday. We were talking about this major key support, okay, with a bullish invalidation level of 72.82. That's the yearly open. So you're looking for a drop to get long with our bullish invalidation at 72.80. This was Sunday. You got that drop, and yesterday it came right into that region, and you had a really nice long trigger to get some long exposure on the Aussie. Certainly the rebound panned out really nicely. So here's what Aussie dollar looks like first on the 30-minute. Well, let me take you to the daily chart first. It's a messy one, but I do want to highlight a couple of things. So if we take a longer look back at the Aussie, just to sort of give you some scope on where we are in trend, this is the broader ultimate structure that we're trading within. This is off the highs that you made in 2011 and the 2013 swing high that you made in March or April. And so that's sort of the larger encompassing formation that you're in. Within the confines of that, you have this ascending structure. Okay, we came off a big region on Brexit. It was an exact 100% extension off the low. It was the median line. It was the April low day close from 2015. And obviously an outside day reversal off of that shifted the focus lower. Look at the descent. It seems to be following this formation here. This is a basic pitchfork just off the lows from March 16th and the April highs. Really nice pivots at the median line. Really nice pivots at the lower median line parallel, catching support. And the upper median line, well, we can say specifically on a close basis, right into that as well. So as we started the week, the reason we started to look for some support is because we were right above that median line. And certainly you had the yearly open, which converges dead on now with the 200-day moving average at 72.82, 72.81 or so. So for me, this is still sort of the invalidation for the near term. And here's what it looks like on the 30. And here's what we looked like last night. So you got that drop into key support. Really nice trigger on building divergence. Here's what the 5-minute chart looked like. Interestingly enough, you had a 5-minute divergence into the lows backed by a trigger break. And this was the entry for the long side of the trade. 26 pips is a quarter of the daily ATR is what you're looking for per scalp. So really nice opportunity to get on the long side for Aussie. At this point, you're seeing a little bit of a pause here, but the broader trade still remains unchanged. 72.82 is the bullish invalidation. Inevitably, you would be looking for a rally towards 75, which would be basically just a basic test of former support as resistance. Major key resistance, 75.90. And a breach here is what would shift the broader focus hold higher for the Aussie dollar. Questions on Oz before we move off? You're pretty spent on Aussie data for the rest of the week as well. Remember, early next week, we do get the RBA on tap on the 5th of July, so keep that in mind. But Aussie level still looking pretty clean in my opinion here. Okay, so if no one's got any questions on those three, Swissy, CAD, and Aussie, let's jump into the primetime sterling crosses. So feel free to throw out any questions or trade setups that you guys want to review. I kind of flew through these today. Here's what the British pound looks like. I showed this yesterday on the Daily FX webinar, but I think it's worth keeping a good eye on the weekly chart for the British pound. In fact, I can go a step further here and show you guys the monthly chart. Okay, we don't have enough data over on FXCM for the monthly charts to go back this far, but I did want to highlight sort of a couple things that me and Jamie have been looking at. I know he probably showed you this as well. A basic trendline support off of the 85 and 2009 lows just broke, okay? And that highlights key resistance near term right around this region here, okay? Which is basically the confluence of the median line. This is a longer term median line, former trendline support, now resistance, and the key 618 retracement. This is of the entire ascent from that 1985 low. Look where the 764 retracement comes in, and look where the 50 line of that formation comes in, right here. Okay, right around 130, 130.30. So from a monthly standpoint, you are coming into a very interesting area of support just lower for the British pound. Keep that in mind. Okay, take a snapshot of this if you need it. Moving over to the weekly charts, an embedded formation just off of the highs they made in 2014, the low they made in 2013. You can see the median line here also converging on the lows we're making. This completes a 100% extension from the descent off the 2014 high and basic trendline support from 2001, 2001, 2008, and right now. So you could see a pause. We're not calling a low to the pound. We're not saying that this is the end of the decline. I do think that you get deeper for sure. Does it cause or does it prompt some pause here for the downside? Sure. Could we get some play on a rebound? Sure. You have a basic trigger here in support, in momentum rather, excuse me, off the lows, suggesting again that you could see this thing find some near-term, reprieve from all of the downside pressure. Eileen's saying, general question, how to determine liquidity, a gauge. So liquidity is a lot of different ways you can look at it. Most of the ways you want to kind of check it out is on the futures markets and seeing sort of where the orders are and how much push we're getting. Obviously, FXCM also has open interest. I'm not sure if I have it installed on here. Or volume. Which also shows you how much interest traders are making or how much position taking is going on. Obviously, this is a weekly chart, but I do have it. So let me bring up the daily chart for you, Eileen. Here's the British pound on a daily basis. Okay, so you're seeing some interesting spike in volume that we made, obviously, on Brexit. It wasn't even as high as the spike in volume that we made here May of last year. So to put things in perspective, but you can see over the last couple of days, volume has been low. Market participation much shyer to start off the week because, again, not many people know how to play this. This is not what the markets expected. This is not what was priced in. And so this repricing obviously is going to scare some people out of taking any new positions, and volume is seen here as sort of below average at this point. So Eileen, hope that helps. A little bit more transparent on the futures markets, but definitely something to take into account. So for the pound, we kind of checked out the weekly chart just now, right? And I wanted to highlight again this formation. We're coming in some support. Interestingly enough, if you look at the daily chart, there's a lot going on as well down there. You have this formation, which is held super clean, obviously outside the break that we made here, but basically since May of last year, you've been holding this slope exceptionally well. And the lower median line parallel of that formation comes in just below where we halted. In fact, if you take a sliding parallel off that low, we basically almost caught this on a closed basis right there. Okay. Beyond that, basic channel resistance off the 2014 high, a parallel off that to the 2015 low, gives us a level just low around 30.80 or so, right? And again, could go as low as 30.40, right? And again, that monthly chart, 764, is at 30.30. So there's a lot to sort of look at as far as near-term support for the pound moving lower. I do think ultimately, guys, this does give you a much deeper break just because it doesn't look like we're going to get a resolution or any type of tidy cleanup of the situation from Britain in the foreseeable future. So there's likely to be a little bit more turmoil before this thing turns around. Long story short, I'm not interested in chasing the shorts at this point. And as far as the near-term price action is concerned, I'm looking for a little bit more of a conviction turn. Keep in mind a couple of things. A, we haven't even covered the gap yet. You would need a rally towards 36.58 just to cover the Sunday gap. And B, we haven't even broken the weekly opening range yet, which is something I definitely want to see. I know this doesn't look like a lot here, guys, but this is a 300 pip move. This is just to take into account the whole drop. So, if you zoom this out a little bit, you'll get a little bit more of a picture on where we are. But long story short, you're carving out a pretty decent weekly opening range. I want to see price action be a little bit more constructive. You're just starting to peak 60 here for the first time this week, excuse me. And if we do clear the weekly opening range, I'd be looking for some long triggers against a session low to try to get that fill of the gap. But super, super nimble. Super, super nimble. This is if you feel compelled to trade the sterling, guys. On whole, I'd probably say just stay out of it for now. I think we'll get a lot more clarity once we get deeper into the week. Keep in mind as well, we're heading into the close of the month. We're heading to the close of the quarter. In addition to sort of the shock that the market just went through, can make some pretty treacherous trading conditions. So please make sure we're keeping that in mind. Yeah, Eileen noting that 25% of the ATR for sterling is 71 pips. Yeah, believe it. Believe it. That was the biggest single day drop that we saw in the history of the pound. So not surprised to see ATR really completely blow out. Eileen quoting me on whole stay out for now. Yep. Yeah, it's probably the best play, Eileen. I'm not gonna lie to you. I did, play this pound trade during Brexit, but again, super nimble. You don't want to take a position here that you're going to press until we get a little bit more clarity. Odds are we fill the gap and move much lower before this thing actually puts in a low. So that's the British pound. Amir, let me know if you have any specific questions on the pound. For pound yen, if you really want to play with fire, here's what pound yen looks like. The only thing I'm pointing out here, the only thing I've been watching is this basic 786 retracement. This is a long-standing retracement that dates all the way back to the lows that you made in 2011, I want to say. Yes, in 2011. Okay, so from September of 2011, a 786 retracement takes you into 3377. The high for 2011's opening range comes in at 3347. Okay, it's exactly where we just bottomed. So near-term resistance, former slope support. And the last couple of days, that's exactly where this thing peaked. So very similar setup here, Amir, for pound yen. Okay, the weekly opening range is set. The weekly opening range is set just above support and just below structural resistance. So I think you have a very nice sort of range play here to look for the break. If you do get the breach, look for the recovery, possibly back as high as that low from earlier in the month, right around 144, 145.40, 145.60. While a downside break, there's really nothing on tap till 25.80, and that's a ways away from where we are now. I don't think the 30-minute has anything too interesting here. Very similar to what you're looking at with the pound dollar. The RSI divergence on pound yen on the daily? Yeah. No. I wouldn't want to use these divergence points, Eileen. It'd be much more convincing if these 2 points... Yeah, too far back. I would be much more convincing if these 2 points were divergent, or even sort of the low for April and the low for now. Technically, this is still not divergence in my eyes. On the near term, no divergence either. So we'll keep an eye on it for it, but I think it's a little too early to tell. Also, keep in mind one other thing, guys. Divergence in and of itself has no time value. Something can stay on a divergent signal for days and days and weeks and months. I can show you a dollar-yen chart if you go back far enough where this thing was, showing divergence for weeks before it finally turned over. So remember, divergence only is going to be something we want to pay attention to when we're coming into support. So Eileen, I would love it if you're at divergence right here into support. That would be a positive development for sure, but it's just not there yet. Mir wants to take a look at Euro Pound. Sure, here's what Euro Pound looks like on the daily chart. A basic slope resistance seems to be catching this for now. Haven't really been too involved in pound yen, but let me take a step back here and show you what I'm looking at. So a basic trendline resistance extending off the highs from 2000. Well, it's not the actual high. It's the March high of 2009 and the subsequent high that you made in November. Okay, actually, let me adjust that just a little bit. Okay, we kind of just turned ahead of it here in 2013 on the drop. Looking into euro pound at this point, look where we capped out the advance. Upper median line parallel, trendline resistance back that we just checked out, and that's sort of capping this for now. Let me move that confluence right around here. So look, it's at risk for sure for a pullback. I do think you get a pullback towards the 50 line, which would take you as low as basically yesterday's low in price. But more importantly, to fill the gap would need to drop all the way this low. Now, this could be a breakaway gap. I don't know. But I do think the euro and the pound should see a little bit more back and forth on the back of this. So, yeah, I wouldn't be interested in any long exposure until you get either some settling here near the 50 line or a fill of that Sunday gap. Let me see what the near-term chart looks like on this mirror. Okay, we don't need this anymore. We don't need this anymore. This constituted an exact 100% extension off of the highs. Really nice move. Yeah, I would say the broader trade still remains constructive here. Mir, you're coming into some serious resistance. I do like the turnover you're seeing in momentum, for sure. Specifically on that rally, you did see a break into oversold conditions, but here's your first move sub 40 this week. So on the rally here, if we do rebound, look for resistance to cap out near 60 and for us to maintain the weekly opening range. You know, all of these pairs, the pound pairs, are basically doing the same thing, okay? You've set a weekly opening range into resistance here. Pound dollar set the weekly opening range into support or just ahead of support. Pound yen set the weekly opening range just above support, below technical or structural resistance. So I think you're seeing the same exact thing here. You made a gap. You stretch into a new high. Your opening range basically is this right here. And if it does breach the highs, I mean, you have a long way to run. I don't even know if I have any targets beyond here. Let's see. 85.52 would be a first soft target, followed by 86.11. The major measured move is all the way up at 87.98. These are huge moves we're talking about, guys, and this is sterling pips. So keep that in mind. Gunshot approach right now, I'd be looking for a pullback towards the 50 line, towards the Sunday gap for a breach higher inevitably. But as it stands right now, you're definitely coming into an interesting area of near-term resistance. Mir, does that make sense? He says yes. All right. And just for argument's sake, let me just tack on this retracement real quick. Yeah, I mean, all the same levels come out. Beautiful. So, in fact, a basic 236 takes you basically into the opening range low for the week, and a 38.2 fills the Friday gap. This is beautiful. So the levels are pretty clear. That's obviously assuming that we've made some sort of near-term high here, which we don't have conviction for. But that being said, with the structural resistance line that we're looking at, near-term support, this is the break that would sort of sent you back towards a run towards the Sunday gap. and then we'll have to reassess it from there. But certainly the long side is vulnerable near term. Is there two Amirs in the room, says Amir. Is there? No, Amir. There's a Mir and an Amir. You might be hearing them sound the same. We got a Mir Y in the room and an Amir Halal in the room. So you're both welcome. Any questions on Euro Pound before we move off? All right, guys. So that's pretty much everything I have right now. We're going to get more play on these, I'm sure. Things to keep an eye on aside from that. Gold, obviously, everyone's watching gold and the rally that we're seeing here. I am in the process of writing the gold forecast for Daily FX. Here's what that chart's going to look like when it's finally published at the start of the month. Look, I mean, I remain constructive on gold long term. Now, the fundamental piece that Ilya Spivak will write for that report is going to be a little bit more of a bearish tone. But from a technical standpoint, gold in the longer term, I still think remains pretty constructive. As it stands from here, you're at risk. And you're at risk because the larger play here is the continuation of the formation that we've been in from the highs. Okay, this is a basic trendline resistance off the all-time high. This is a basic 618 extension, off the low. And just above that, you have the 38.2 retracement of the entire descent from the record high. So this is the level to beat for the breakout play, for the for the reversal, whatever you want to call it. As it stands right now, I do think that you're at risk while below 1358. So I'd be looking for a drawback towards the 50 line, a drawback towards 1240 heading into next quarter, basically liking continued strength while above the actual concerted median line here for ultimately a breach and a breakout of this descending slope off the record highs. So you'll see this chart published, like I said, over the weekend or next week at some point when Daily FX publishes the quarterly forecast. Feel free to take a snapshot for your future reference, but big level of resistance, and certainly that massive range that we posted on Brexit coming right into that key level, reversing, right, and still holding below the sliding parallel, which is basic slope of the same operative formation. So should be tracking risk pretty closely, and specifically with what's happening now in Europe. If U.S. data softens any further, interest rate expectations are likely to get kicked out. There's nowhere else to seek yield, guys, and if markets turn over heavy, gold is going to be an ultimately should catch a very, very decent bid. As far as SPX is concerned and the risk assets are concerned, that's also something that we've been watching very closely. Here's what the SPX looks like on whole. I know Jamie highlighted that support line. This is a support line that Jamie's been watching on the longer term. It's a basic modified pitch for that basic trend line off the lows from 2009. Here's what that pitchfork looks like here. Really nice pivots along the median line. That's just what we tested right now. For me, I've been watching this slope. I know that we got a little messy here around the median line, but look where slope support converges. 50% retracement, former channel support, and a measured move of that initial range into the highs that we just made. So an equal leg down from here takes into 1967, 1972 as an area of key support for the SPX. Immediately as resistance right now, by the way, you have a couple of things. The 200 day moving average. Former channel resistance. And my line moved somehow. Sorry about that, but the low from May. So near-term resistance right here. Questions on the SPX? Again, notice 60 resistance. This is pre-Brexit, 60 resistance. The day ahead of Brexit, we made a rally, 60 resistance, reversal off of the high day close to the tick almost for 2015. Here's our 2015 May high day close. We reversed right off it on Brexit through the monthly opening range. An outside month for the previous month, bearish as you can get off resistance. Again, look for that rally near term 2025 or so. Initial resistance. If that breaches, I'd still want to stay bearish below the monthly, below the yearly open, which is at 2057. All right, so that is the risk market here with the SPX. Okay, we'll revisit this one later in the week. All right, guys, if there are no other questions, we'll go ahead and wrap it up here. Again, keep in mind, there won't be a webinar tomorrow. I will be in Southern Jersey for an appointment, so I won't be able to make it for the webinar tomorrow, but we do have the midweek strategy webinar with Jamie. That'll be at 1 p.m. tomorrow, and then we'll be back on board here at 8:30 Eastern on Thursday morning to wrap up the week and give you a nice look. Pete, for the euro dollar, sure. Can't believe I forgot to talk about that. Haven't taken any trades on that personally, Pete, but here's what the daily chart looks like, man. It's getting kind of messy, but the one thing I do like is this. See this formation? And remember we were talking about this, looking for the break below this, which we got on Brexit. We closed below, but this formation still has me like pausing here. You know, we turned right ahead of the upper median line parallel. We never closed below the lower median line parallel. And for me, I'm sort of focused on this region right here. 111.28 is the monthly open. I want to stay bearish below that. But we're coming off of structural support. I don't know if this is going to hold, guys. So for me, I'm really focused on just near-term price action. We've now filled the gap from Sunday. We've tagged that 200-day moving average. There is at 111 exactly a 618 extension that comes into play off the highs. Let me just zoom this out and snap these levels for you. There we go. Okay. I guess this is the best view here for you. So we saw a downside break of the ascending formation, the one that you were looking at here on the daily chart, right? So that should keep the focus weighted to the downside, basically while below the lower median line parallel that we just broke. But like I said, you have the monthly open, you have the 200-day moving average offering some resistance, and as long as we stay below these regions, I'm really not looking to play or fade this move yet. In fact, at this point, let's clean this up a little bit. Let's work with that 50 for now. Sort of highlight this pivot in price right around here. Momentum signature still looks pretty bearish. And technically, that would be the bearish invalidation level. So initial resistance, look at 111.20. 111.28, basically the low that you made here in the monthly open, right? In fact, I remember that low specifically on the scalps. We were looking for long exposure into that region, and it actually ended up being the low that took us into the key resistance level we were looking for all month long. That being said, initial resistance right back at that same level, 111.28. Bearish invalidation, I'd have to put at 112.30. So as long as we stay below 112.30, I'd be looking for that rally to give me some short exposure. Now, that doesn't necessarily mean we can't play the long, guys. And again, there's that 112.30 level actually. It shows up really nice here on the 30-minute as well. Doesn't mean we really can't play the long. But for me, I'd need to see a sort of pop above 111.28. That gives you a 100 pip range here to play into 112.30. But I'd still be very cautious. Okay, you're heading through some longer term slope levels, and for me, kind of to squeeze the juice out of this one, the best bet is to wait for a rally towards that median line, towards 112.30 if you can get it, to get on the short side here for euro. We might not get a move that high, guys. It's been a heavy trade, and even on the 30-minute chart here, you can see resistance at 60. Looks like a support trigger is about to give out. Yeah, we'll see what the U.S. Open has for us. But basically, a play on this one, Pete, would require a little bit more of a rally before I can feel safe trying to short it. You're not that far off as far as the weekly opening range. Is still pretty tight here, considering, all things considering, the ranges we've been seeing, right? So not the cleanest picture for yet. I'd like to see a push higher. Wish I had more conviction for this one on you, for you, Pete. Does that make sense, though? He says, yeah. Okay, cool. And key support, by the way, still down here. Major critical region. It's exactly where we bottomed out last week. It's 100% extension, 109.08. 618 retracement, 109.35. Huge level of importance near term for the euro. Yeah, you're more than welcome, Pete. More than welcome. Dollar CAD still ranging, and Aussie. Let's see if we can't get a pullback to get back on this one as well. All right, guys, I will wrap it up here. Again, like I said, reminder, no webinar tomorrow, midweek strategy webinar with Jamie at 1 p.m. tomorrow, and then we'll pick things up on Thursday morning with another intraday strategy session. Till then, best of luck trading. We'll see you then. Cheers, guys.